Preparing for FP&A Analyst at ABB interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a manufacturing business like ABB? FP&A turns operational activity into forward-looking financial insight. At ABB, I would support annual planning, rolling forecasts, monthly variance analysis, and management reporting across manufacturing, projects, and commercial functions. I would connect revenue, orders, utilization, material costs, labor, inventory, and overhead to business performance. The value is not simply producing reports. It is explaining what changed, identifying risks and opportunities, and helping managers make better decisions before results are finalized. While answering, focus on planning, forecasting, performance analysis, operational partnership, manufacturing drivers, decision support, and how FP&A connects financial results with production, sales, inventory, and profitability. Question 2. How would you build a rolling forecast for an ABB manufacturing business? I would begin with actual year-to-date results and update the remaining months using operational drivers rather than applying a simple percentage. I would forecast orders, backlog conversion, shipments, pricing, material costs, labor hours, capacity, inventory, and overhead. I would validate assumptions with sales, operations, procurement, and business controllers, then prepare base, upside, and downside scenarios. After each close, I would compare forecast to actuals, investigate errors, and improve the assumptions driving the model. Make sure to cover the forecast horizon, revenue and order assumptions, production capacity, material and labor drivers, overhead allocation, scenario analysis, stakeholder input, and disciplined comparison with actual results. Question 3. Which KPIs would you monitor for a manufacturing division? I would combine financial and operational measures. Core financial KPIs would include revenue, gross margin, EBITDA, operating expenses, cash flow, and working capital. Operationally, I would monitor order intake, backlog, capacity utilization, labor productivity, material price variance, scrap, rework, inventory turns, on-time delivery, and forecast accuracy. For ABB, the right dashboard should show both outcomes and causes. For example, falling margin may reflect pricing, product mix, inefficient labor, material inflation, or production downtime. In your answer, talk about financial and operational KPIs, including revenue, orders, margin, utilization, productivity, scrap, inventory, working capital, on-time delivery, and cash conversion. Question 4. How would you analyze a gross margin decline in a manufacturing business? I would bridge the margin change from the prior period, separating price, volume, mix, materials, labor, overhead absorption, foreign exchange, and unusual items. Then I would identify whether the issue is commercial or operational. For example, lower margin could result from discounts, unfavorable product mix, copper inflation, overtime, low utilization, or production inefficiencies. I would quantify each driver, validate it with business owners, and recommend actions such as repricing, sourcing changes, productivity measures, or capacity adjustments. Be sure to mention price-volume mix analysis, material and labor variances, overhead absorption, product profitability, foreign exchange, one-time items, operational causes, and actions to recover margin. Question 5. Explain the difference between a budget, forecast, and actual result. A budget is the approved financial plan for a defined period, usually established before the year begins and used as a performance baseline. A forecast is management's latest expectation of how the year will finish, updated when conditions change. Actuals are the results recorded through the accounting system. I would compare actuals with both budget and forecast. Budget highlights accountability against the original plan, while forecast variance shows whether current expectations are changing and why. Focus on purpose, timing, ownership, flexibility, and use in performance management. Explain how actuals are compared with budget and forecast to improve accountability and decision-making. Question 6. How would you perform a monthly close and variance analysis? I would first confirm that the close is complete, including accruals, allocations, inventory postings, depreciation, and intercompany entries. I would reconcile key balances and compare actuals with budget, forecast, and prior year. For material variances, I would drill into transaction and operational data, speak with responsible managers, and distinguish timing from structural issues. I would then prepare concise commentary explaining the cause, financial impact, outlook, and corrective action, while escalating unexpected risks promptly. Cover data validation, reconciliation, accruals, review of actuals, variance thresholds, root cause analysis, stakeholder discussions, commentary, and timely communication of risks and actions. Question 7. What is standard costing, and how is it useful in manufacturing finance? Standard costing assigns predetermined costs for materials, labor, and manufacturing overhead to products or activities. It helps AB value inventory, estimate product profitability, set expectations, and analyze differences between standard and actual costs. I would review material price, usage, labor efficiency, and overhead variances, then investigate whether the cause is supplier pricing, engineering changes, waste, productivity, or inaccurate standards. Standards should be updated through governance, because stale assumptions can distort margins and management decisions. Mention predetermined material, labor, and overhead costs, variance analysis, inventory valuation, product costing, standards maintenance, and the importance of investigating outdated or unrealistic assumptions. Question 8. How would you explain a material price variance to a plant manager? I would explain material price variance as the difference between the actual purchase price and the approved standard price, multiplied by the quantity purchased or consumed, depending on the reporting convention. I would separate supplier increases, commodity movements, currency, freight, purchase timing, and specification changes. I would avoid presenting only a negative number. I would show the affected materials, quantify the impact, confirm the operational context, and recommend sourcing, pricing, or design actions. Discuss the calculation, purchase price versus standard, quantity effects, supplier and commodity drivers, timing, controllability, clear communication, and actions such as renegotiation or specification review. Question 9. How do you forecast inventory and working capital for a manufacturing business? I would forecast inventory from demand, production schedules, bills of material, supplier lead times, safety stock policies, and expected shipment timing. I would model raw materials, work in progress, and finished goods separately because their drivers differ. For working capital, I would also forecast receivables using sales and collection patterns and payables using procurement and payment terms. I would monitor days inventory, DSO, DPO, and cash conversion, then test scenarios for demand changes or supply disruption. In your answer, cover demand, production plans, lead times, safety stock, raw materials, work in progress, finished goods, receivables, payables, cash conversion, and scenario sensitivity. Question 10. What is SAP FICO, and how would you use it as an FP&A analyst? SAP FICO combines financial accounting, which records external reporting transactions, with controlling, which analyzes internal costs and profitability. As an FP&A analyst, I would use general ledger data, cost centers, profit centers, internal orders, and profitability dimensions to analyze actual performance and support forecasts. I would verify master data mappings, period status, allocations, and reconciliations before reporting. SAP provides the actuals foundation, while planning tools and Excel may be used for assumptions, scenarios, and management analysis. Explain FI and CO roles, general ledger, cost centers, profit centers, internal orders, profitability analysis, master data, reporting, and the need to reconcile SAP data with planning tools. Question 11. What is the difference between a cost center, profit center, and internal order in SAP? A cost center captures costs for an ongoing responsibility area, such as a production support department or finance team. A profit center tracks revenue, costs, and profitability for a business unit, product group, or region. An internal order is usually a more specific object for temporary activities, projects, campaigns, or investments. I would use each according to the management question, ensuring postings have correct master data so budgets, actuals, allocations, and accountability remain meaningful. Make sure to distinguish recurring responsibility areas, profitability units, and temporary or specific cost objects, then explain how each supports budgeting, reporting, accountability, and variance analysis. Question 12. How would you investigate an unexpected expense posted to the wrong cost center in SAP? I would trace the posting to the SAP document, reviewing the account, amount, posting date, cost center, internal order, user, vendor, and reference information. I would determine whether the issue came from incorrect coding, master data, an allocation, or a system interface. After confirming the proper destination with the business owner, I would arrange an approved reclassification before close, document the correction, assess reporting impact, and recommend a preventive control if the error could recur. Cover document level review, account and cost center validation, master data, user or process error, correction entries, approvals, audit trail, recurring controls, and impact on management reporting. Question 13. How do SAP FI and CO support a monthly management reporting process? FI provides the legally oriented accounting record through the general ledger, while CO organizes costs for internal management analysis. During close, transactions are posted, accruals are recorded, overheads may be allocated, and results are reported by cost center, profit center, order, or product. I would reconcile FI and CO views, verify allocations, and use those dimensions for actual versus plan analysis. This allows management to understand not only total expense, but where it arose and which activities generated profitability. Discuss transaction recording, cost allocation, organizational dimensions, period close, actual versus plan analysis, profitability reporting, reconciliations, and how FI and CO perspectives complement each other. Question 14. Describe a driver-based budgeting approach for a manufacturing plant. I would start with the plant's operating plan, expected units, product mix, production hours, labor hours, headcount, machine utilization, material requirements, energy consumption, maintenance, and quality costs. I would assign rates or assumptions to each driver and build the income statement and cash implications from them. Fixed and variable costs should be distinguished, while capacity constraints and inflation should be explicit. The result is more transparent than applying historical percentages and supports meaningful sensitivity analysis. Focus on operational drivers such as units, labor hours, machine hours, material rates, headcount, energy, maintenance, and capacity, linking assumptions to financial statements and accountability. Question 15. How would you evaluate whether a capital expenditure request should be approved? I would first clarify whether the investment supports growth, productivity, safety, compliance, replacement, or capacity. I would validate the capital cost, implementation timing, useful life, depreciation, incremental revenue, savings, working capital, and residual value. Then I would calculate payback, NPV, and IRR using an appropriate discount rate while testing downside cases. I would also compare alternatives and assess execution risk. After approval, I would track actual benefits against the business case rather than treating approval as the endpoint. Mention strategic need, capacity, safety, compliance, payback, NPV, IRR, depreciation, operating savings, timing, risks, alternatives, and post-investment review against the original business case. Question 16. Tell me about a time you improved a reporting or forecasting process. In one reporting process, analysts manually consolidated several files, which created inconsistent definitions and delayed commentary. I mapped the data sources, agreed on standard KPI definitions, introduced controlled templates, and automated recurring calculations using Excel Power Query. I added validation checks for missing entities, duplicated records, and unusual movements, then documented ownership and review steps. The process shortened preparation time by roughly 30% and improved confidence in the numbers. I would apply the same disciplined approach at ABB. Use a structured example covering the initial problem, data or control weakness, actions taken, stakeholder involvement, measurable improvement, and how the process was sustained. Question 17. How would you handle conflicting data between SAP, a planning tool, and an operational report? I would not choose a number based on convenience. First, I would define the reporting scope, period, currency, entity, and metric, then identify the designated source of truth for each data type. I would reconcile totals from SAP to the planning tool and operational report, checking master data mappings, timing, eliminations, and interfaces. I would trace material differences to transactions, agree the correction with data owners, document the resolution, and escalate only after completing the evidence-based analysis. Be sure to cover source of truth principles, period and scope alignment, master data mapping, reconciliation, transaction-level testing, stakeholder ownership, documentation, and escalation of unresolved differences. Question 18. How would you analyze the financial impact of a supply chain disruption? I would quantify the disruption across volume, timing, cost, and cash. The analysis would include missed shipments, production downtime, alternative material pricing, expedited freight, overtime, inventory changes, customer penalties, and working capital effects. I would build base, delayed recovery, and severe scenarios using operational assumptions from procurement and plant leaders. Then I would highlight the most sensitive drivers and potential mitigations, such as alternate suppliers, production resequencing, customer prioritization, and selective inventory deployment. Discuss volume and timing effects, material prices, expedited freight, downtime, inventory, customer penalties, working capital, scenarios, mitigation actions, and communication to operational leadership. Question 19. How would you communicate bad financial news to a non-finance manager? I would lead with the business impact rather than accounting terminology. For example, I might say that margin is below plan by $400,000 because a product mix shift and supplier increase were only partly offset by productivity. I would separate controllable from external factors, explain the evidence, and avoid assigning blame. I would then agree specific actions, owners, and timing, such as repricing, sourcing review, or production changes. The conversation should create accountability while preserving trust. Focus on clarity, business language, fact-based explanation, distinction between controllable and uncontrollable drivers, quantified impact, actions, ownership, timing, and constructive partnership. Question 20. Why do you want to join ABB as an FP&A analyst? ABB appeals to me because it combines industrial technology, electrification, automation, and a meaningful sustainability agenda with complex global operations. That environment creates a strong FP&A opportunity. Financial analysis must be closely connected to manufacturing performance, project execution, supply chains, and customer demand. I would bring disciplined analysis, strong Excel and SAP-oriented thinking, and a collaborative approach with operational teams. I am especially motivated by turning detailed data into clear actions that improve profitable growth and cash generation. Connect ABB's industrial technology, electrification, automation, global manufacturing footprint, sustainability agenda, analytical culture, and the role's opportunity to partner with operations and improve decision-making. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.